Hi, I'm Roxane Webster.
Hi, everybody, and I'm Keith Alba. We are the owners and partners of My Home Team Denver at Keller Williams Advantage in the Denver metro area.
And this is The Honest
Yeah,
Hour.
that's it.
Woohoo!
Our opportunity to come and pontificate on things touching, adjacent to, surrounding the real estate industry and how we see it affecting the real estate market here in the Denver metro area.
And you know how it works, folks. The algorithms like us a whole lot better if you hit the subscribe button, if you share what we're doing with other people, the little notification bell, all that stalker stuff. Please go ahead and hit subscribe.
Free license to stock
Yeah.
via YouTube. Via YouTube. Let's just clarify
Yeah. Yeah.
that. I don't need random cars out in front of my house at strange hours.
What's the
Not
old
not
joke?
providing for.
What's the old joke? Um, my my boyfriend says I'm a stalker. What's a stalker? I'll remember it later. Right.
Yeah.
Such a good joke. Such a good joke that I can't remember it. Whatever. Stop me before I
Age.
kill.
It's age.
Age, that's what it is. Um, well, I have been talking with you at least, and with, well, if I'm honest, with anybody who will listen about this kind of growing dis-ease I have in the FHA and VA market. And now we've got a little bit of data to support that. The
Yeah, and
dis-ease,
specifically what you're referring to, Rox, just for clarity's sake, is somebody that has purchased a property using FHA or VA within the last few years.
the last few years. And the advantage to using an FHA or a VA loan is that in the case of FHA, you can get in with a much, much smaller down payment than a conventional loan, usually 3.5% down payment. And if you can get the seller to pay your closing costs, that's a much lesser amount than most conventional loans, where you're going to be doing 10 or 20% down payment. There's some that's less, but for the most part, that's it. And with the VA loan, you can get in with no down payment, right? So if you can get
For
the seller,
eligible vets.
that's right. That's veterans, one of their benefits, right?
Right, but there is certain eligibility criteria in order to get the full 100% loan to value sort of a thing. But
Yeah,
it's possible and it works.
and it works. And these are great programs that have helped encourage home ownership in people, and all the other stuff that you would normally have to have credit ratings and be able to document your income and your ability to repay the loan and all the stuff that one needs to show when they're getting a loan all exist with these programs. It's just you don't need to have as much cash on hand to finish the transaction, which is why they've really helped boost home ownership, right? So I love
Yeah,
those programs. Yeah,
that and some looser qualifying standards, I would say. Credit score minimums for FHA is lower than a conventional property.
that's right.
Um, and it is really designed to increase the opportunities for people to become homeowners, which is why their government programs, they were put in place by the government to help, these qualifying people to obtain the loans.
That's right.
FHA, really, it's just kind of income credit, that sort of a stuff is qualifying with the VA. Obviously, you have to have some sort of a veteran's record, either active or former military, in order to be eligible. And then
Yeah,
once you're in, again, different criteria for how much you may be eligible for. But
that's right.
great programs across the board and definitely have expanded home ownership, in my opinion.
The concerns that I've had regarding these have been that the past couple of years in particular in our market have been rather stagnant, right? It's almost like we've been in this stagflation period, right? Where um, the buyers aren't really interested in paying what people are listing their houses for, but the sellers aren't dropping the prices. So it just has kind of slowed everything. You've described it really well as a big exhalation of the market. We haven't seen profound drops in values. We've seen pockets where the values have come down, and we'll continue to see that. But for the most part, the values have kind of held neutral or maybe 1%, 1.5% appreciation per year, where the average appreciation over time, good years and bad years, tends to trend right along 4%, right? So it's been a little bit of an, an anemic market. Oh, look at that. Say that 12 times,
Whoa.
right?
Yeah.
So my concern has come, we've got that situation where people have, normally if it's going to cost them 8 to 10% to sell a house, by the time they pay me, by the time they pay the buyer's agent, if they choose to do that, by the time they pay for their title insurance and their tax prorations and whatever else, it's going to cost them between, 7.5 and 10% to sell the house. Well, if your house is gaining 4% in value per year, that means 2 years, maybe three, you can break even on that sale, right? Where you're not going to likely have to bring money to the table after it's appreciated. If it's appreciated 4% this year, and then another 4% the second year, that's eight. And then another 4%, that's 12% that it's gained value in those 3 years on average. Now, if it costs you 10% to sell it, you've got some room to sell it, maybe replace the furnace for the buyer if they ask for it, you're good to go, right? But if we're
Right. And
only sitting at, yeah,
this is above and beyond your down payment, regardless of
that's
what
right.
that down payment was. If you're a VA borrower and you had zero, you want to have, this appreciation in order to absorb those cost of sales that are there.
That's
Otherwise, you get the privilege of bringing your checkbook to the closing table in order to have the right to sell your property. Because
that's
there
right.
are those expenses, and if you have no appreciation and no equity in that property, right, those
You're
those
really
expenses
upside
are going to
down.
come from somewhere.
That's
Right.
right.
And
Yeah,
so if you put 20% down, maybe you're not getting that 20% out if you sell within a short period of time, like in Roxanne's example, of less than 3 years, and you haven't had the opportunity for the market to build that equity, then you're coming back with, maybe 18 or 17% of that original down payment that you put in when you bought the property 3 years ago.
that's right. So you're losing some of those initial inputs, which is, a choice that you make if you're selling, or sometimes are in a position where life events are causing you to need to sell, right? Um, if we take that same math and the values have only been sitting at, let's say, 1% depreciation, then it means to get up to that 8 or 10% cost of sale, you'd need to own the property for 8 to 10 years if it were only gaining 1% in value in order to break even and not have to bring money to the table. Or if you had put a larger down payment to realize a lower refund of those, or recapturing of those monies, right?
Yeah, and I
Um,
think it's important here, Rox, to just explain real quick that
yeah,
we're using simple math. We're not using compounding
that's
interest,
right.
right? Your property
None of
goes
that.
up 1 year, 1%, then the next year you're taking 1% off of the top, to that appreciation to get another 1%. We're
I'm
not
doing
going to go that
chimpanzee math. Yeah,
we're not going into that thing. We're using easy numbers, but there is an opportunity. Like if you needed 10% to close and it was 1% appreciation 1 year, it would be less than 10 years that you'd have to sit in that property in order to get, up
yeah,
there. But
but
for
it's
simple
certainly
math, for
not going to
ease
be
of
three.
understanding,
Yeah,
yes.
it's going to be more than three, right? And so when I take a look at that reality, that we've kind of got this stagnant market where people who bought in the past few years with low down payment or no down payment really are not in a position, unless they can bring some money to the table, to shake loose of that house easily, without having to bring money to the table to do so. Then the factors that have been making me nervous are the environments of increasing expenses that we've had, and we've had them from several different areas. We saw property tax assessments go up, depending on the property, between 40 and 60% a couple years back. Big increase in property taxes. And we're seeing similar increases in property insurance right now. Well, was it you who told me that you read that we are third in the country for cost of homeowners insurance?
Yeah, we're up there. Top five, I want to say, I
We're in the
think is
top
what I
five.
saw. Yeah.
Our homeowners insurance is expensive, gang. right? Not only that, but because we've had so many big claims that were weather related, we're seeing a big, this is the repayment for my roof that just got replaced last year, right? My insurance company just sent me the final check. But at the same time as they sent me this final check to replace the roof, they informed me that the deductible for any future roof weather related events has just been increased from 1,500 deductible to 5,000 deductible, right? So our insurance environment is really increasing the out of pocket that homeowners are paying for claims and the premiums that they're paying for the insurance itself. So we've got somebody who is in a position where they can't sell right now without having to bring money to the table to do so, and their property taxes have gone up as much as 40 or 60%, depending on what the property assessment was, and their homeowners insurance rates are likely to have increased significantly, and their out of pocket expenses if they do have an insurance claim. We've got cost of fuel, gas prices have been jumping up and down and up and down, but mostly up. And that at some point is going to impact the cost of groceries and other goods. We've also seen national housing starts have reduced again, they've slowed, right? So all of these are kind of creating a perfect storm where I'm worried about buyers who don't have much equity in their house, if any, and the house is getting too expensive for them to live in. And I think that this is a statistically significant group of people. And we're now seeing some data, right? At the end of 2024, it was estimated that FHA had a delinquency rate of 11.03% and VA of 4.7%. Now, these are national numbers. And that these delinquencies have been rising faster than conventional loans. And that we have seen a couple of the programs, the ways that the banks have of handling working out things with you if you're in trouble have changed a little bit. And these are really interesting. Before I move into these program changes, do you have any other color commentary from the dome?
Yeah, no, I think, we're starting to see potentially the front end of some of these delinquencies starting to hit our real estate market, right? Up until this point, the what we would consider a distressed sale, so something that was either has gone through the full foreclosure process, is owned by the bank, and it's coming back on the market as the bank as the owner selling it, or a short sale where the borrower is saying, hey, I'm in this position where I don't have the money to come to the table. I can't afford to continue to make these payments. So, bank, will you agree to accept a payment for less than the principal balance that's left on the loan that you gave me? Those two things are really what makes up distressed market or distressed sale in our market. And for years, we've seen this like insignificant, less than 1% in terms
Much
of the
less than
total
1%,
sale.
less than half a percent. Yeah,
Yeah.
yeah,
They just haven't been there, which is, I think, part of the reasons why we've seen some of that stagflation, right? We're not seeing massive downward pressure on the pricing because we haven't seen these distressed sales hit in the market. But at the same time, we haven't seen this massive buyer demand that would drive that prices up and, have that appreciation at something greater than 3 or 4%.
that's right. That's right. So, what does one do about this, right, as a market? And there are always, we saw during the Great Recession, we saw a bunch of government programs came out to help homeowners who were in these type of situations, loan modification programs, et cetera, so various incentives. So these programs come and these programs go, right? But we've seen a couple of changes in specifically the VA and the FHA market in the past year, right? There was a program that the Veterans Administration had called VASP. Forget what that stands for. It's an acronym, of course, it's military. But this is one where when you get a VA loan, for the most part, the VA isn't your lender is whoever your lender is, Bank of America, Chase, your credit union, etc., right? But because you're using it as a VA loan, VA is guaranteeing to the bank if this person doesn't satisfy defaults on this loan, will make you whole. right? They're guaranteeing it. Um, well, with this VASP program, if a veteran had a profound hardship, right? Um, and they've got definitions. We can do longer visit at a later point of what that is. But this was a straight up rescue program, right? Where you've got somebody who, for one reason or another, is not able to pay the loan at the terms that they got that loan. And in that case, the Veterans Administration would actually buy back that loan from whatever service, whatever bank had issued it, Bank of America, Chase, whoever. They would buy back that loan, and then they would reissue that loan, in essence, refinance it to the veteran at a lower interest rate. So it would forever lower the payment for that veteran, so that hopefully it's more sustainable to them over the long term. That program is gone now. That was discontinued in 2025, last year, right? Now what we're seeing the Veterans Administration doing more of is where they will help the veteran. It'll cover their past due amount to the servicer. That'll pay them for those amounts, right? But then they'll create, in essence, a second mortgage that gets paid off upon the closing of any future sale. So it's not like a HELOC where my phone ringing. It's not like a HELOC where you've got your first mortgage and you're paying that every month, and then you've got this other loan and you're paying a payment on that every month. In this case, your old mortgage payment, you're making your normal payment, whatever was past due gets bundled up into a new loan, but it's called a silent second that doesn't have to be paid upon or serviced. It just is a lien against the property that at some point in the future, when you sell that property, that lien gets paid off, and the VA gets their money back, right?
Right. And that was a great program while I was around, right? Because all of a sudden now, not only are you not threatened by this foreclosure potential action that's there, because the old lender has been made whole, they're happy, they've got their money. VA has now bought the loan. So
Yeah,
not just the past due amount, but the full outstanding principal was paid off on your behalf. And now you're essentially getting a new loan at a substantial discounted rate with the intention of, okay, let's take some of this burden of these payments off of you so that you can stay in your house, make these new mortgage payments amount, and then in the future when you're ready, you can sell the property and we'll recover those all the funds at that time.
that's right. So now the partial claim is they don't buy it from the servicer. So if I got behind on a $3,000 a month payment, the VA will um will bundle up and make that silent second that doesn't have to be paid about, but my loan is still where it was. My payment hasn't changed, right? So if I have had a life event that has changed forever my ability to pay that $3,000 a month, this is a program that won't do much good for me. What they've got now, the partial claim. If it's
You won't
just
even
I had
qualify
a
for it, right? I
well,
mean,
no,
they're going to look at
because with the partial claim, you don't have to qualify for it. You have to be able to make your payment for 3 months, right? That's it. But it's the same payment you got originally, right?
right.
So if you think about where this will be useful for people is if somebody had a life event that was temporary. Somebody lost a job, somebody had a baby, somebody whatever, broke a leg,
Medical
right?
expenses.
Medical expense, something that was short term, but that initial payment that they had bought the house with was something that was sustainable under most circumstances and will be again once they're past this rough spot, right? In that case, this partial claim program will work just fine, right? You resume your payments as if there was nothing happening wrong. The VA says, okay, we'll take whatever these back payments are, and you can pay them off at the end of the loan, and you continue sending off your payment to Bank of America or Chase or whoever it is that you got the loan through because they still own that loan. That's the only program. What we don't have now, which we had before, was this restructuring loan where VA buys the whole loan back and refinances it in essence at a lower interest rate. That no longer exists, right?
Right. So the difference being, one that was restructuring, new interest rate, new payments, all of that sort of stuff. This one is just removing the past due or removing the past due stuff and putting it into a second loan type of position. But the monthly payments are going to go right back to where they were before. It's not a restructuring. The interest rate that you had when you refinanced last or purchased the house is still going to be the refinement, and that's what the payment's going to go back to, is that
So
amount.
another way to think about it is if your problem was temporary, the program that we've got now with partial claims will work. If your problem is long-term loss of income, long-term, one of the spouses died, one of the income streams, right? That that other program of restructuring just caught more people, and more people were going to be able to stay in their home at that reduced payment. So that's a change, right? The
Yeah.
FHA, go ahead. The FHA change that we've seen is they've got the same exact type of program. I think this is probably what the VA modeled theirs off of, the partial claim program and loan modification, so forth, forbearance. But basically, same thing where your payment is going to continue unabated the way it was supposed to be, but they take whatever those overages are. I mean, your back payments, turn them into a silent second and you pay it off. They tack it on to the end of the loan in essence, or add another loan that's going to be paid off upon closing. But now they're requiring you to make three sample payments before you'll be approved for that, which it's very interesting. I've been seeing in title work we get title work before we go on a listing appointment. And I always look at, what's the loan situation. And I've been seeing this weird thing where you'd have an FHA loan that somebody got, and then 2 years later or 3 years later, a second FHA loan, no such thing, unless it's one of these packaged silent seconds,
Yeah.
but that silent second might be for 40,000, and then a year later you see another silent second, that one paid off the 40,000, now there's a new silent second for 60,000, and then a year later a new silent second for 120,000, right? Which means that this person got behind, got this silent second, they got behind again, they got a new silent second that paid off the first one and was a little bit bigger for the overages, and then they got behind again. So that person, the FHA program has just been kicking their problem down the
Down the
the
road,
street,
down the
right?
proverbial road. Yeah.
Down the proverbial road. Which, if we were in an environment where houses gained 20% in values, like we had for a couple of years there, okay, that's a shell game that may work, right? But
Right.
under normal circumstances, not really, right? And so we're seeing a situation now. I think it's probably a good thing that now they're asking, okay, if we're going to give you this silent second, we want you to demonstrate that you can continue making that initial payment for 3 months before we authorize this silent second, so that we if there's going to be a long-term problem with this, let's deal with it now rather than deal with it 18 months from
Yeah. So essentially, what's happening is FHA buyers getting behind in their mortgage payments, say they couldn't make it for 4 months, reach out to their lender and say, "Hey, this is what's going on, and I'm in trouble." And what the lender does is effectively puts the pause buttons on any foreclosure proceedings.
That's right. That's
It says,
exactly it.
"Okay, we'll be willing to work with you and help you out, but you got to demonstrate that you can make these payments on a monthly basis for the next 3 months before we will put this solution in place for you.
That's right.
Otherwise, we're going to hit the unpause button. We're going to go back to the rights that were granted to us as a part of the promissory note and the deed of trust, which says no pay, no stay,
That's
meaning you're
right.
not making your mortgage payments. They have the right to come and foreclose on it. So it's a temporary proving status, I guess, would be a better way, another
That's a
way
great
of
way of
saying
putting
it.
it.
Is, hey, prove to us you can make these payments, do it for 3 months in a row, and you'll have access to this solution which is that silent second that Rox has been talking about. But if you don't, we're not going to just continue to delay this and delay this and delay this and ultimately have to do the inevitable, which is take the property back and sell it on our own. So difference in pieces. But I think for the most part, and if you're in this type of a situation, reach out to somebody with knowledge, right? Have them help you guide you down this path. We're happy to have some conversations with you to do some initial due diligence. We've got some resources for you to refer you out to say, okay, here's an avenue, go talk with this person, go talk with this person, and then here's what ultimately we want to do, and have you talk to, your lender. That's one of the big keys that I think that you and I have always seen is when you get yourself in trouble, meaning you can't make your mortgage payments, you're behind on mortgage payments, you miss the mortgage payments. The wrong thing to do is go the ostrich approach
That's
and just
right.
bury your head in the sand.
The
You want
sooner
to
you
have
start looking for answers, the more options you have, right?
right. And don't
Um,
be afraid to talk with your lender, right? They may not have your best interest in heart, but at least you'll get some information. And the more information you can share with them about here's what I'm doing, here's how I'm trying to rectify it. Ultimately, they don't want your house. They want your mortgage payments because they make their interest and their servicing fees and that kind of stuff off of those payments that are in there. So their game is not owning houses, it's giving loans and then collecting the fees that are associated with that loans. And that's their main interest. But they're going to get to a point of like, okay, does it make sense for us to try and work this out? And that's where the communication, dialogue, and willingness to be transparent with them is going to be key.
yeah. So I would say, when I started looking at these numbers, I've been through a few market shifts in my day, right? Um, and, there's always that sinking feeling when there's a sector of the market that has got a higher risk factor, right? Especially when we're coming off of so many years of such a low default rate. That said, between you and I, we have got, I would use the word profound knowledge and experience on the problems associated with people who are struggling with their mortgage payments. We not only understand the programs, we understand the process, we understand how the bank works. We've got people who you can talk to. We've got attorneys if there are legal questions. We've got CPAs if there are tax questions, financial planning questions. And it is complicated stuff. And each one is a unique life form, right? Um, Please talk to us earlier rather than later. The best time is to be talking to us when you think you're going to miss a mortgage payment, not when you actually do, because that's when you've got the most options. We can get you a lot, we can sometimes work to soften whatever this period is going to serve up for you. It can be anywhere from a tough period to a disastrous period. And sometimes the difference between those two outcomes is getting some good advice and coming up with a good plan. So we'd love to help you make that plan.
Yeah, absolutely. We come in, with our knowledge and experience, but no judgment. We
That's right.
understand that life can be rough at times
Completely
and
confidential.
things happen, bad things happen to good people. And so there's no judgment on our part. Really, what our goal would in those situations is just to bring you information, help guide you down the proper path for you, which is like a snowflake. It's going to be individual and unique to everybody's scenario, how long you've been in the house, what the income situations is, all of
What do you
these
have been
different factors
saving?
go
What's your
in.
retirement
There's
account look
not
like?
a
I mean, all of it. Yeah,
there's no rubber stamp of, hey, this is the best option. It is really truly going to need to be custom crafted to you, your scenario, and the options that come from that.
that's right. That's right. All right, gang. Good conversation, long conversation. We'll do this again soon.